Hi everyone, this is Jason Burak of Wall Street for Main Street, and this is your video blog for Wednesday, August 4th, 2010. Today I wanted to specifically talk about consolidation in the precious metal mining sector, that is for gold and silver. I did about a 10-minute interview for the Financial Tube and touched base on this a little bit with Jordan Trensman, but I wanted to go a little bit further in depth today on this video blog because I forgot a few things and wanted to get the word out there, the news and the information for you guys. So let me break down my thoughts on the consolidation in the gold and silver mining sector a little bit further for you all. In the last week or so, Barrick and Newmont have both raised their dividends. They have both had very good earnings despite gold prices dropping over the last month or so into the higher end of the 1100 range, mid to higher end of the 1100 range. So the fact that these guys are raising their dividends, in fact, Newmont raised the dividend 50%, shows that the board of directors is very confident that those mines that are now online for Newmont can be very profitable, even at around $1,100 gold. So I think that's very bullish. That's adding value and wealth to their shareholders who are holding the stock. Goldcorp also plans to raise their dividend too, probably within the next 6 to 8 months. So the three main ones, Barrick, Newmont, and Goldcorp, which are basically the three largest gold mining companies in the world, they're all planning on raising their dividend if they have not done so already. So that shows that even the larger ones who tend to be more bureaucratic and have more inefficiency. Yes, they have some scale, but they also tend to be more inefficient. So those ones, if they're having record cash flows, I think that's good for the whole sector. You look at Agnico-Eagle and some of these other miners in the sector, and they've done very well too. Hecla Mining is another that's done very well. Last week, Hecla had another record earnings. The previous quarter was very good, and this quarter was also very good. Hecla has a market cap of about $1.2 billion, and they have about $200 million on the balance sheet. So in 6 to 8 months, if Hecla stays at around this market cap, Hecla, on its projected cash flow and profits and cash added onto the balance sheet, I think Hecla will easily have $300 million on their balance sheet. So there will definitely be moves being made in the sector consolidation-wise. Eric King of King World News did a blog about this a few days ago, so I will link to that. But there's been some big acquisitions recently. Kinross just took out, I believe, Redback Mining. And these acquisitions take a long time. So people are going to second guess, oh, they overpaid or whatever. But you got to realize that these acquisitions take normally like at least 6 months to negotiate. And then there's a lot of back and forth between the board of directors, the management teams, and also the the largest institutional holders of these stocks. A lot of them are getting asked behind the scenes. So there's a lot of back and forth going on. This is not like a fantasy baseball trade here where it's like, oh, hey, I'll trade you this guy for this guy, and we're going to make this move. We're going to get a deal done in an hour. That's not really how things work in the business world. So those acquisitions take a long time to work out. So the price probably fluctuated, and obviously in an acquisition scenario, you're going to have to pay a premium. I think there's going to be a lot more consolidation over the next 2 or 3 years. I know a lot of the gold experts have been saying this for a few years now, but I think in hindsight, I think a lot of them would admit they jumped the gun. What happened a couple years ago is a lot different than now. I think a lot of the input costs are more stable now. I said that in my interview on the Financial Tube. I think the main input cost, besides labor and steel, one of the other main input costs would be oil prices, because these mining companies need diesel and other petroleum products to help in the refining of the metals. So I think oil prices are basically in a trading range, and I think these mining companies can see that, and they can see that gold and silver over the next few years are going to rise faster than oil, because I think the oil market's the oil seems to be going up maybe a little bit steadily, but I don't think we're going to have a runaway explosion in oil quite yet. So I definitely anticipate gold and silver prices rising a lot faster than oil, and that's probably the main key to the long-term success of these companies. And that was not happening 2 or 3 years ago, as oil was going every which way, and then oil spiked to 147 a barrel, and those mining companies were probably left scrambling. So I think a lot of factors are pushing towards consolidation. you look at a lot of these companies producing record cash flow. The example I gave you with Hecla there, Hecla will be a severe mispricing in 6 to 8 months. It might have 400 million on the balance sheet, 400 million cash on the balance sheet, and still have a market cap of 1.2 billion. That would be a severe mispricing to me. And the board of directors and the management of Hecla are going to say, well, we're going to force the market to revalue us. So some of the buyout options for Hecla, some of the companies that Hecla will want to go after, some of the main ones would be First Majestic Silver, a Great Panther Silver, and Endeavor Silver. Those would be my top 3 takeout candidates, with First Majestic and Endeavor being the first 2 main ones, since they would add the most production immediately to Hecla's production. They would be very accretive. So I would definitely take a look there. Goldcorp a few months ago also bought out Can Plants. I think Can Plants was not in production yet, but I think they have a provable deposit that was very close to production. And Pan American Silver also bought out Aqualine. So there are a lot of the bigger name companies with the production, with the cash flow, who are looking to go and buy up the junior producers and some of the junior explorers that have a better drilled out project. So I think as a shareholder, as an investor, there is more than one way to play this successfully. If you're already invested in the mid-tier or the large or the senior producers, I would start reinvesting maybe some of your dividend profits into the smaller companies, into those smaller junior producers and some of those junior explorers. I think this consolidation will occur a lot. It'll start accelerating. I can see it accelerating now, but I think it's going to last probably easily 2 or 3 years. So I definitely think you guys, there's a lot of money to be made there. If anyone has any other questions, feel free to hit up me or Mo Dawood on the Wall Street for Main Street Facebook fan page or on our blogs. Thank you, everyone, and have a great rest of your week. I am out.